So what we will do today is we'll talk about uh, a summary of the 2025 and also the outlook for 2026, economic, market outlook, and also geopolitical agenda, what's shaping up. So 2025 was a very volatile at the very beginning a year because of tariffs, but you've seen results of it been very positive for all the markets across the globe. Anticipation that the tariffs will play a very harsh role on the economy due to inflation, higher, lower consumption, less money in the consumer pockets, but that didn't materialize. The effect of tariffs will be seen a couple of years down the road. However, the current tariff rates is half what the statutory rates been announced. As a result, economy was sustainable. We did see some layoffs, but the technology still did very well. Everything AI related did exceptionally well, and in international markets were a top performer. The US markets did well. They were up between 14 and 16%, depending on the index. International markets did more than that by quite a bit. So when I was developing a thesis around the same time last year, I asked myself about international markets and if it makes sense to increase allocation. And after giving it a lot of thoughts, I thought that would be a good idea for two reasons. A, diversification, low valuations, and also the dollar decline. So the dollar been weakening last year. As a result, a lot of performance from international markets came due to the dollar. Nevertheless, there is a lot of stimulus that's been announced and the NATO spending in Europe, and that also boosted the European economy. So what about this year? How things will change as far as our anticipation for upcoming, midterm election? What about international markets and emerging markets? So let's talk about the US first and we'll move into international. So we anticipate, you can see in orange, the projected GDP growth has dropped in Q4, but we anticipate that it will rebound towards second half of 2026. And that's why that was corresponding with some layoffs in technology sector, with some weakening in the consumption, but not to the degree of recession. We still expect GDP hovering around 2%. I listened to one of the presentations from various analysts, and some of them anticipate that because of AI, because of technological advancements, our GDP might surpass 3%. That hasn't happened in many years in coming years, maybe not 26, maybe 27 and after, because of all of this R&D, research and development spending, and companies are doing a lot of development in the AI space, spending money. That stimulates economy, and result we potentially will see it into earnings. Inflation has been a big concern, and you can see here, which is depicted in the orange line, that so far inflation has been contained, very close to what the Fed is expecting. Fed has been very accommodative, even though the inflation rate not exactly where they want it to be, they start cutting rates. The rate cuts generally is very positive for the economy, and market welcomes it a lot. So there is a result, even though the market is expensive, which is one of the negative factors affecting future performance, the market likes the cheaper money, it likes the rates being cut. And once Powell goes into retirement in May of this year, we might see even further rate cuts to stimulate the economy. The treasury rates are also supportive of the mortgage rates, and mortgage rates supportive of real estate markets. So we see that real estate market prices potentially can bottom in 2026 and starts to recover. When I say bottom, it doesn't mean that in Bay Area we will see declines in prices of the real estate. We're talking about nationwide. Nationwide prices for real estate been softening. We see further softening, but it's probably will end as the interest rates become more and more attractive on mortgages. And real estate market is one of the big parts of the economies. You start to see people buying new homes and upgrading their lifestyle. It results into home builders rebounding in many other areas, employment in those industrial areas improving. So that can be very positive towards second half of the year. This you can see here kind of general outlook on GDP in various countries. The US seems to be pretty stable at 2%. We've been at 2% for many years, and if we're at 2%, it's probably a good news. So there is no recession at the current view. Eurozone still struggling simply because they cannot keep up with US productivity, with the way US workers put in their efforts into Europe is much more relaxed. So as a result, we do know there are some innovations coming from Europe, but Europe has a lot of issues, a lot of spending, and that drugs the economy. So I'm not emphasizing Europe this year in the portfolios for that reason, but I do have exposure to certain areas. And that's due to diversification because I want to capture some of the good companies that have a lower valuations in your portfolios in order to stay more broadly diversified across the globe when you're talking about making money. Asia, excluding Japan, you can see growing at a much better rate. And if you look at emerging markets, they're also very stable. So this is the area of the market that potentially can be very beneficial for investors for a few reasons. As we talked about valuations, future valuations are very important for the current valuations are very important for the future market returns. That the higher the valuation, the more expensive the stocks are, the lower future returns are. And the US has been the case for the last couple of years. So I'm very cautious about buying very expensive stocks because the future returns may be very muted. So emerging markets become very interesting and opportunistic place to be in your portfolio where we can see potential advantage of emerging markets growing faster. As a result, their stock market and their currency will appreciate, and we can take advantage of that. You have to be very careful what type of emerging markets you're in. You need to make sure it's a transparent investment at lower cost. So there is a lot comes with that, but ideal that you have exposure there as well, especially if the resources become available. And you can see how resources that needed for production of AI and energy will be consumed from outside of the US. So I'm very, very curious. So the global growth is stable for this year and next year. We will see if there is anything like that changes. So a lot of conversation going about we've been in the bull market for a while. You can see current bull market on the slide, and we are right now going into year 3 into 4. So generally, so 2022, 23, 24, 25, yeah. So 22 was the down year, and then after that we're counting the bull market. So generally it's a positive year. It's probably not going to surprise us with returns that double digit, but maybe solid single digit return in a portfolio that 100% stocks is not out of the question. However, this year is the year of midterm election, and usually it's a heightened volatility that accommodates the election. So I expect the volatility increase. That means the risk premium for stocks increase, and there will be a lot of opportunities to buy certain stocks. What's interesting to note that if you look even at technology sector, which is already by itself a pretty small sector in the economy, it's not as small maybe as others, but in a stock market, big global scale, it's only one piece of the overall companies. However, even inside of that small sleeve, you can see that different companies performing very differently. For instance, semiconductors are at the all-time highs as of today, where the software companies or infrastructure companies like, I'll give you an example, chip makers, NVIDIA, Broadcom, Amazon, Meta, they're all down. They're all down for the last couple of months. So they are taking profits, they're taking a breather where semiconductor is powering through. So even as in technology sector, there's a lot of dynamics going on that you need to take advantage of and pay attention to. So, which I'm doing because I'm adding some to the portfolio that's valuations has decreased and became more attractive. This chart showing you that as we start to see the rate cuts, the stock market generally has a very nice performance. So the teal line is showing the cuts with no recession, and all other cuts would be in blue, so I probably will rely more on that number. And when the rates are cut during recession, the stock market generally down, so you see it's below the zero performance. So if we avoid recession, then we can count on probably a good single-digit positive return for most indices, US and international. AI investment by hyperscales is massive and still increasing at a solid rate. So you can see how much growth rate is associated with AI infrastructure, and every big company, we call them Magnificent Seven, play a huge role in corporate earnings and also in spending. So that has not slowed down. In fact, we expect it to grow in the next couple of years. Uh, Interesting note about Magnificent Seven versus the rest of the market. So Magnificent Seven are in dark blue, and the rest of the market, or S&P 500, including Magnificent Seven, is in orange. So you can see that expectations for this year are the overall companies that are not just Magnificent Seven will continue to have a positive increase in their earnings. Where Magnificent Seven, some kind of all over the place. They first quarter they're first quarter they're lower, much lower than previous quarter, and the Q2 they rebound, then Q3 potentially decline. So they are in waves. They are not straight line up. So that means that opportunity in those companies also will be not on a straight line. There will be a hand picking stocks and be careful rebalancing of technology allocation, and it's not going to be as easy to make money in technology as in the last couple of years, only because the companies are expensive and they can't grow at the fastest rate all the time. The good news is when we have a broadening of the earnings of the rest of the market, that plays a very positive, solid performance matrix overall. Because it's only 10 companies performing well and the rest are not, that's a very low breadth. That means if anything happened to Magnificent Seven, there is nothing to support it. Now we can see the rest of the companies are picking up and they're having a higher earning growth. That means that economy has a better footing and more solid performance across many, many companies. We spoke about midterm election. You can see that the second chart right here, realized volatility is quite high. The returns are usually pretty low, but also the drawdowns means how down we can expect the market to go in midterm can go all the way to 17% without any reason. That means for any bad news, there will be an excuse for the market to sell off. For us as an investors, it's an opportunity to rebalance and buy some stocks. And for those who are not savvy in the volatility and don't see an opportunity, there will be a reason for worry. I wouldn't worry about it, but I would make sure that everyone here on the call and everywhere else that I have I help with have enough reserves, because reserves will be important to sustain the volatility and also creating an opportunity. So we always make sure we have enough reserves. I will quickly jump on bonds, and also after that show you a couple other slides that I found very interesting that comes from Capital Group that does a lot of good research, and I would then after that would love to hear your questions. So expectations of the bond returns a lot comes from the current yield. So current yield is an indicator of the future returns in the bond market. Current yield is about 4.5%, 4.5, 4.7. So we expect the bonds to make about 5% return in general terms. If it's a companies that has a higher allocation to high yield bonds, then yield will be maybe 6%, 6.5%, and that return might be a little bit higher, but there's also with some risk. But general overall aggregate bond index should produce solid 4.5%, 5% return in the near future, 1 to 2 years, which is a very good alternative to cash for us. As we will not talk about the spreads, we will talk about alternative investments. What is alternative investments? It's the way to participate in the market, but not particularly maybe in US market or international market traded securities. Sometimes it could be participating in some sort of credit, either US or non-US, that pays a high yield. So one way for me to take advantage of alternative investment without going into a black box of hedge funds is to look around the globe to see where we have the best yield that with the least amount of risk. And there's a few companies that do a very good job in research, giving you an opportunity to participate in those credit. What does credit means? It could be a government debt, it could be a big company corporate debt overseas that pays a very decent yield. And if today US market valuations are very high, which means the future returns may be muted, maybe they can be only a 6 to 7% return, getting the same return from the credit market, from bonds, can be very attractive because you're taking by far less risk in bonds than in stocks. So looking for opportunities in alternative investment space with low risk, low expense ratios, and a higher probability of success is another way for us to diversify and look for returns outside the regular equity markets. That part been always interest me because I want to find where I can make the most amount of money, the least amount of risk. And right now, opportunity is there because overseas credit quality is improving, and some countries becoming more stable, the currency becoming more stable, that they're paying a very nice yield on their government bonds, 6-7%, where US treasuries pay 4 or 2 3.5 maybe if it's short-term T-bills. So it could be a double the yield. Now I'd like to go into and let me know if you don't see the screen here. So I will open this up. Oh, this one. All right, here we go. So couple other slides I wanted to bring to your attention. I hope you see that. That's showing that global growth we talked about. So this is other research from another company, but they're all pointing out to average US GDP growth between 2.3 to 2.5%. Global growth, I'm sorry. The US GDP is 2.1%, so another consensus hovering around 2%.